Okay, so we moved from chapter 1 to chapter 2. We've got a couple review questions here. Capital budgeting or financing decision? Group Modelo decides to build a new brewery. How would you classify that? Capital budgeting or financing decision? Capital budgeting would be the right answer. Now, how about this next one? Borrowing money. Yeah, that's the financing. So capital budgeting, you're buying real assets for the business to run the business so it can make money, produce goods and services. Financing decision, where do we get that money from? Which business form is subject to double taxation? Yeah, the corporation. Most people nowadays, if you were to go ahead and start your own business, most people would do something called an LLC. An LLC, it's a little bit more expensive than a sole proprietorship. You have to pay like extra taxes to like the state of California. I don't remember how much that is. Maybe someone here knows. I think 20 years ago, 25 years ago, it was about $1,000 just basic tax you had to pay just the right to have an LLC. And what an LLC is, it's kind of a combination of a partnership and a corporation. So it has some of the liability protection of a corporation, but for tax purposes, there's no double taxation, and all the profits go straight to your personal tax return. So that's a common one that most people are doing these days for a lot of startup businesses. But the answer to this, yeah, is a corporation, and that's how most large corporations are formed. And because it's the easiest way to get lots of investors. There's no limits to the number of investors you have in the business, to the number of shares you issue. Whereas with like an LLC, there are some limitations on how many different investors you can have. What is meant by separation of ownership and control? And what problems does it cause? Does anybody want to take a stab at that?
Is it like having like balance between how much control an owner has in a company?
Yeah, it's
Kind of like that. And then I don't know what problems it could cause is like financial problems, like taking more money out of the company without like letting investors know about it and like stuff like that.
yeah, exactly. It's like, imagine if you paid someone to run all your personal finances. It's kind of like that, right? And so you better be sure you trust that person, right? Because they may do something that doesn't help you. And so that's kind of the separation of ownership and control. Like, what if, we call that problem agency problems. And so you hear about agents, what do? They represent entertainers and athletes. And so you probably heard of a story, right, where some entertainer or athlete got an agent, and somehow the agent did some bad things and gave some bad advice, and it kind of hurt that entertainer or athlete in the long term. So you probably hear a couple of those stories. But I think even they're trying to pass more laws to make it so that athletes and entertainers don't get taken advantage of. What can we do to solve these problems, these agency problems, or problems that come from the separation of ownership and control? We talked about one today. We had it on the homework problem. That was takeovers, right? Because if someone comes in and buys up a company, they can fire management. So that's one solution. Boards of directors, definitely. Corporate governance. Sometimes very large shareholders can exert more power because they own so many shares, they can call up the CEO directly, and they probably have a large control over the board of directors. very often when a company wants to take over another company, sometimes that's what they do. They own so many shares that they can decide who gets to be on the board of directors, and they put their own people on the board of directors who then can make the decisions to like fire management. Okay.
Professor, just to reiterate what you said about large shareholders, that doesn't really happen in the United States, right?
It happens sometimes, but it's not the norm. It's more common in other countries. Like for some reason, Korea comes to mind. I know there's some you know, like Hyundai. There's some huge companies that are still significantly controlled by families.
All right, thank you.
We have a few companies here too. We have, I think Ford Motor is still pretty well controlled by the Ford family. But not quite as many as you see in some other countries.
Thank you.
Okay. Compensation plans is definitely another one. So only compensate the managers when they're doing things that also help the owners, like raising the stock price. That's why sometimes, you know, using stock options or shares of stock to CEOs, the owners like it because that way the CEO only makes money when the stockholders make money. But then sometimes the performance of the CEO and the value of the company aren't always in sync because, like, I mean, look at just like the last couple months, the stock market went up, you know, 30-some% for some companies. Did CEOs do a 30% better job? Not necessarily. So the actual performance of the CEO and the stock market aren't always aligned. So that's the problem where, you know, a company may not do that well, but the CEO still made lots of money because they had these stock options. So because when the stock market goes up, it's like a rising tide. The water brings up all the boats up. They all float up higher. And so that's why even a company that's not doing well, when the stock market goes up, it brings up all the companies up. So sometimes they have to balance the compensation with something else as well, like a cash bonus or something. Okay. Let's just take a look at where finance sits within the company. So if you have like an organizational chart or an org chart, at the top should be the board of directors because they oversee the CEO or chief executive officer of the company. And then the chief executive officer, sometimes they change the name. Sometimes it's president. Sometimes it's CEO. Sometimes they take on the role of CEO and chairman of the board. So they keep coming up with kind of different titles to help make people, you know, feel better and more important and, you know, kind of raise their stature. And then underneath the CEO or the president, they may have vice presidents. And here again, depending on the size of the company, they may call their vice presidents something else. Maybe they call them senior vice presidents. They might call them senior executive vice presidents. So they have lots of variations. And usually those vice presidents are organized by maybe operating companies or divisions or functions. And that's what I have here is the function. So they usually have like a vice president who does sales and marketing, or maybe that's separate. It's one for sales, one for marketing, depending on the company. Then they'll have one for operations. Operations is like they run the manufacturing side of the business, or if the company, you know, develops software, maybe they're the design engineering vice president. Then you have a finance vice president. Sometimes those people are also called chief financial officers, CFOs. And then you have human resources vice presidents, and then sometimes information systems vice presidents who kind of run the accounting systems, all the technology behind the scenes. And now under the finance VP, depending on the size of the company, with a large company, you might have a separate treasurer and a controller. The treasurer handles more of the typical finance side in terms of they manage the cash for the company. So they always have to make sure that when they get excess cash, that they hurry up and invest it in something like a CD or something to maximize the amount of return they get on their money. A lot of companies don't like to just have their money sit there not collecting interest. So if they have anything extra, they'll put it into something that tries to get a little bit more interest. The treasurer also works on how to raise capital. So this is the financing decision. Do they sell stock in the company? Do they sell bonds? Do they take out loans? But that's the raising capital part. And then they also are responsible for communicating with investors in the business. So you'll see most companies have an investor relations website, and you can get tons of information. You can look at presentations that companies do, because every time they present to investors, they record those presentations and they put them up on video, and you can see the CEO of the company, the CFO of the company, and they'll talk about their strategy and what they're planning to do to make the company better. The controller side of the VP of Finance, that's the traditional accounting side, and that's where they're looking at, okay, how do we pay taxes to the government? Let's calculate that. Let's do our financial and managerial accounting that you learned in your previous accounting classes. And they'll also do something called budgeting, where they figure out how much money they're going to spend next year, and they give every single department a certain budget on how much they're allowed to spend. And then throughout the year, as they go along, they keep forecasting how much they think they're going to spend. And sometimes if things aren't going well, sales are down, then they'll go out to the departments again, and they'll give them a revised budget. And they'll say, you know, we gave you $1 million to spend 6 months ago, but now sales are down, so you're only going to be allowed to have $800,000 to spend. Or they might go out and say, you know what, we're gonna cancel all travel and entertainment for the rest of the year, so we're not going to approve any more travel and entertainment to make sure we hit our profit numbers. So that's kind of the budgeting part of the controller's function. And like I said, this part under finance is a big company, because as you get smaller and smaller, there are fewer people who work in the finance section of the company, to the point where if you go to a very small business, they will not have any finance people working in the company. A very small business might start off with a bookkeeper. And what a bookkeeper does is they will take the transactions and they'll put them into the accounting software, probably Quicken or something like that. And then the company, they will go ahead and hire an accountant, probably at a CPA firm, and that accountant will create their financial statements, and they'll do all their taxes for the company. That's a small company, and that's kind of how they typically operate. But then as you get bigger, and so I'm sorry, in that example, probably the owners of the business would be making some of the financial decisions. They might ask the accountant for some advice, but when it comes time to figure out how to raise capital, managing the cash, that's something the owners of the business will likely do. And then as a company grows, they might bring an accountant in-house. And so that accounting function that they used to hire a CPA for, now they do it internally. They still probably won't have a finance person, but then eventually as they get bigger, especially if they become a public corporation, then they're going to have a finance person, because now they have to interact with the financial markets. They have to figure out how to raise capital. They have to talk to investors, and that's where we definitely need a financial person coming in. So that's just a little interesting tidbit. I'm sorry, I didn't see a question here until now. The question is, Can you briefly explain the control part of separation of ownership and control? So the control part is basically management. Management has control over the assets of the company on a day-to-day basis, and they decide how to run the business. So when I say control, I mean management. Is there a difference between CEO and president? It depends on the company. Some companies, they'll have two different people, and some companies, it'll be the same person. It all depends on what the person can negotiate for themselves. Typically, CEOs get paid more than presidents, so they'll try to negotiate, hey, I know I'm the president now, I want you also to say that I'm the chief executive officer. It's kind of 6 of one, half a dozen of another, but when boards of directors figure out how much to pay their president, they'll hire an HR, human resources consulting firm, and what that firm will do will go out and see what other presidents and CEOs are paid at all other companies. And so I'm not an expert at this, but I think in the HR world, there's a point where a company moves from having a president at the top to having a CEO at the top. And I'm not sure what that point is, but it does happen somewhere, and it's partly based on negotiations between the president and the board of directors, what title they get to have. All right, let's talk some about financial markets now and institutions. So on the left side of this chart, we have investors. Investors, they basically have the money. They're the public, and they have savings accounts, they have retirement accounts, and in those accounts they have money, and they're looking for a place to put that money or invest that money to earn returns, okay? And then on the right side, on the complete other side, we have companies here that need money. They need money to buy real assets and start businesses, build factories, set up websites, and invest in R&D, create new products, that type of thing. And so somewhere the money has to flow from investors on one side to startup companies and businesses and firms on the other side. And so what's in between? In between are financial markets and financial institutions. Markets are, kind of a big place for transactions, buyers and sellers, kind of like, eBay or something like that, or in some cases like, what's that one on Facebook Marketplace. You could think of that as a market as well. Now, sometimes people need help interacting in these markets, and that's where financial institutions come in. Financial institutions typically provide a little extra service to make it easier, but at some point, the financial institutions also have to use the financial markets to either help sell things or raise money themselves to perform the service for either investors or firms. So financial institutions are kind of like a middle person who helps step in and help either investors or firms to transact in the financial markets. So if you don't want to transact directly in the financial markets, typically a financial institution will help do that for you. So that's kind of the big picture. And typically the money is flowing from investors, and then it goes through the markets to the firms, or it can flow from investors through consultants or middle people of financial institutions, and then to the firms. And so I have a question here. When it says money market short term, does that include loans? Yes. Yes. So I'll get to.
Short term and long term are still defined by less than a year, greater than a year, correct?
Yeah, that's the general cutoff point. Short term is within the year, long term is greater than a year, and you see that pretty much everywhere in finance and accounting. It's in this balance sheet is split up like that as well.
Yeah. Okay.
So let's start here on the left. So investors, right, they have the capital, they have the money, and they want to invest in financial assets to, maximize their returns for a given amount of risk that they're willing to take. And so they can invest in things like stocks, which is basically partial ownership in a corporation. And these stocks represent equity ownership. The alternative, they can also invest in something called bonds. And bonds are basically just loans. But they're loans that have been sold off in little pieces so that companies can go to the financial markets and get a loan from the financial markets through selling of bonds. Let me give you an example. So let's say a company wants to borrow $1 million. What they could do is they could sell bonds, and they sell bonds through the financial markets, and each bond is basically a loan. And typically bonds have a face value of $1,000. So if they wanted to borrow $1 million by selling bonds, what they would do is sell $1,000 bonds in the financial markets. And each of those bonds is a contract, like a loan, and it says how many payments they will make, how often those payments are, and what the interest rate is, just like a loan. The difference is it's packaged into little bonds, each worth $1,000, and they sell as many as they need to equal the total amount of money they want to borrow, and it gets sold through the financial markets. The alternative is like a bank loan, and in that case they just deal with the bank, and the bank says, okay, you want $1 million, here's $1 million, and here's the contract we have for the loan, you have to make payments directly to me. With a bond, the firm makes bond payments to every single bondholder, depending on how many bonds they own. If an investor wants to buy stocks or bonds, but they do not want to go to the financial markets to buy them directly themselves, they don't want to have to sit there and pick which company stock to buy, which company bond to buy, they can do something instead and give their money to a mutual fund. And what happens is they write their check to a mutual fund. It could be companies like Vanguard, Fidelity, Charles Schwab has mutual funds. There are lots of these companies. And what they do is they'll take your money and they'll invest it in certain groups of assets. So they might have a stock fund, they might have a bond fund, and then if you put your money in a stock fund, then they'll go ahead and pick the stocks for you. So the whole lure, the positive of mutual funds is that you don't have to sit and pick the stocks, and they'll pick them for you. So it kind of gives up some of the management responsibility. Another form of investment, but you probably don't usually see it that way, is buying insurance. Because when you buy insurance, right, you prepay, and then the insurance company has to figure out what to do with that money, because they're not going to just let it sit collecting practically no interest. Sometimes, depending on how much they have and the type of liabilities they could get in the future, depending on the probability, the timing of accidents and that type of stuff, they will put most of it in bonds and maybe a little bit in stocks as well. So that's another form of investing that goes out into the markets that you may not realize. And then pension funds. If you have a retirement account, maybe a 401k, something like that, or a company that has a defined benefit plan, the company basically puts some money into that fund, and they'll hire a financial institution to manage that fund, and that financial institution will go ahead and buy financial securities investments on the market as part of that pension fund. So then investors, they go to the financial markets. And this is where they can buy all different types of financial products. And one way to separate those products is based on the duration of those products. So short-term, long-term, short-term less than a year, long-term greater than a year. And money market securities are very popular. They're like short-term loans, and companies like to take them out because usually they're fairly cheap. And you may notice it at your bank as well. I'm guessing, depending on where you go, you'll have a checking account, you'll have a savings account, and you probably have a money market account that you can also put in. And usually the money market account is a slightly higher interest rate. And the reason is that because the money market account, they invest in these short-term loans with companies. But you do have to realize when you put your money in the bank or a broker in a money market account, it's not subject to that FDIC insurance. So like if a bank fails, you're covered up to a certain amount of dollars, and you don't have to worry about losing your money. But often when you go to a money market account, it's a little bit different. But I don't think a money market account has ever lost money that I'm aware of. But knock on wood, it could happen in the future. And then longer term duration financial securities are in the capital markets. And the capital markets are further separated into the primary capital markets and the secondary. So primary just means the very first time financial security is sold. So give you an example. What happens if a company does an initial public offering or an IPO? That's the very first time the company creates the share of stock and then sells it on the financial markets. It's an IPO, initial public offering, and that's the primary market, okay? Now later on, if someone bought that share from the company and they decide to start selling it to other investors, that's the secondary market. It's kind of like the difference between buying a new car and then buying a used car. So that new car is only sold once from the manufacturer direct to the first buyer, but then after that it's a used car and it gets sold in the secondary markets, at least for stocks. And we have a question here. When it says money market short term, does that include loans? Oh, I'm sorry, that was earlier. Yes, all the money markets are loans. Okay, and then on the financial markets, stocks go back and forth between people, and typically the financial markets are separated based on this type of security. So like if you want to buy a stock, you have to go to a stock market, and that could be the New York Stock Exchange, the NASDAQ, which is the NASDAQ, National Association of Security Dealers Automated Quotation System. It's a little of a mouthful, but New York Stock Exchange and NASDAQ are typically the two largest exchanges that people are familiar with. And then we also have bonds. These bonds, these little loans of $1,000 that companies sell off, they also trade through the financial markets. Now bonds, you won't see all of them in exchanges. Sometimes the banks, they have a desk and they have people with computers and phones, and it's a little more of it's a little more like eBay as opposed to an automated exchange of information with buying and selling of shares of stock. Sometimes people talk on the phone. Sometimes they'll send instant messaging about a particular bond for sale. But there are many more bonds and loans available in the market than shares of stock. And one company by itself may have 5, 6, 7 types of bonds. And very often when someone buys a bond, they hold on to it for 20, 30 years. So the market is a lot different than stocks. In stocks, it's much easier to automate the market, and a lot of times no person will get involved between a buyer and seller. But in bonds, it's a little different, and it's it's harder to find a bond that you want to buy. It may not be available, and so people get involved more often with bonds. And there are also markets for commodities. If you want to buy chocolate, soybean oil, all different kinds of markets for that stuff. And CDS is a credit default swap, which is kind of funny. A credit default swap, it's essentially an insurance policy on a loan. So you can buy a bond, which is kind of a loan, then you can also buy a credit default swap, which insures the bond. And anyway, there's so many different types of instruments. A lot of people get confused by it, and that's when they start to bring in financial institutions. Because in the finance world, there's a product to do just about anything you can think of. And from just some real basic advice, and this comes from Warren Buffett, investors, it's best to stick with the simple stuff and not get involved in the very complicated stuff, because the more complicated it is, the more confusing it is, and the more opportunity it is to be taken advantage of. And so a lot of financial institutions have to get involved in the more complicated products. And financial institutions are typically commercial banks and investment banks. Commercial banks are the banks that companies do business with. They have their bank accounts with those banks. They can take out business loans with those banks. And a lot of those banks, they also take deposits from private people, like Bank of America. It's a commercial bank. They take deposits from you, investors, but then they also work with companies and give out company loans. Investment banks are a little different than commercial banks in that they do more of the consulting side in terms of they help companies figure out how to raise capital, how to do an IPO. They help companies figure out how to do a bond offering. They help companies figure out how to sell their company to another company, how to do takeovers. So they're more of the consultants that help people do the financial things that they want to do. The commercial banks handle more of the deposits and the loans. Investment funds are a little different. They're not technically a financial institution because basically all they do is take your money and then put it right into the financial markets for you. They don't offer an extra service like giving out loans, that type of thing. Mutual funds are quite common. If you have any type of retirement fund, chances are it's invested in a mutual fund. And those are the easiest things for people to do, especially if you have a modest amount of money that you want to put into the stock market. If you had $100, it's probably easier to put it into like a mutual fund than it is to buy a share of stock, just because it gives you something called diversification instantly. Because what they'll do, a mutual fund, is they pool the money from lots of investors, and then they put the money in lots of different stocks. Let's say they put the money in 100 different stocks to kind of diversify and make it so not all your eggs are in one basket, so to speak, to kind of reduce the risk. Because if any one company blows up and you only own one stock, then your whole portfolio could go down. But if you own 100 stocks, then the thought process is your portfolio won't be hurt. So there's less risk from that standpoint. And that's why mutual funds make it a lot easier, because it's very easy to diversify. You put your money into one fund and then they invest in like 100 different stocks to make it easy for you. Insurance companies and pension funds, they're financial institutions because they take your money and they ultimately invest it in the markets, but they give you some type of service, right? Insurance company, they'll protect you against a certain specified type of loss, be it a home, be it a car, be it life insurance. And pension funds, they save your money while you're working, so then you can withdraw it later when you retire. And all these, they interact with the financial markets and sometimes directly with companies themselves in terms of lending them money. So those are the financial markets. Here's just an estimate of who owns the stocks in companies in the United States. And you can see mutual funds own about a little over a quarter. Individual investors own about another quarter. And then pension funds own about 22%. And so together, those three, that's close to 3/4 of the total stock market is basically owned by individuals. What I mean by that is the money put into mutual funds often comes from individuals, and the money that's in pension funds often is for individuals in the future. So if you look at most of the stock market, it's really owned by people, different investors. 13% is foreign owned in the US, and about 8% by insurance companies. So what's the whole point of having financial markets and institutions? Well, think about if we didn't have them, what the world would be like. Let's say you wanted to buy some land and dig up some stones and chop down some trees to build a house. How would you do that if you didn't have the money? You'd probably have to go to the local, I don't know, the local royalty somewhere and see if they would lend you money. Could you do that at like 5 or 6% interest? Probably not. I'm guessing way back when, hundreds of years ago, if you wanted to borrow money to build a house or buy a house, interest rates were probably much more closer to 15, 20, 25, 30%. And you probably couldn't pay it back in 30 years. You probably had to do it on a much shorter term horizon. So that's even if you could get a loan. What if you wanted to start a business and you didn't have the money? Let's say we're in the 1500s at some point. Where would you get the money? You probably have to convince a wealthy merchant or royalty or somewhere to invest in your business, right? The mob. Now, hey, I grew up outside of Philadelphia, so I know exactly what you're talking about. I just didn't want to say that. Yeah, you could get your money from the mob, and then what would happen if you didn't pay the loan back? You get your knees broken with a baseball bat, basically, right? So nowadays, it's much kinder and gentler with a financial market, right? So if you don't pay your loan back, a credit agency starts calling you, and eventually they might take you to court or something like that. No knees. So what are the things that we can do now that we have financial markets and institutions? Well, it's fairly easy for people, for companies to raise financing to do wonderful things, right? So people can, they can buy cars and do what they want to do, drive around in cars. They can buy homes and live in a house. And companies can invest and create new products and new services that we couldn't have had before. When I worked in a couple of different countries, and in countries where the financial market system was not trusted, even though they may have had, let's say they had a stock market, but people did not trust the stock market because they figured it was rigged by insiders and the leadership of the country. Most people did not buy stocks at all then. Instead, what they typically bought was either gold or real estate because they figured that would be harder to steal. But when it came to companies raising capital, guess what? Those companies couldn't raise the capital because people were not using the financial markets. they would either have to find large investors outside of the country or to work with the government somehow. And that's where you see in some companies, or large companies in countries where they don't have developed financial markets, a lot of times the government is involved in those big companies, especially with natural resources, be it gas and oil or something like that. Because they have to get the financing from somewhere. And if they can't get it from the people who live in the country, then they have to go to outside the country, or they have to go to, the government in some way. It makes another benefit of financial markets is it makes investing and diversifying much, much simpler. So if all we could do is buy gold and real estate, right? One, we're hoping that gold retains its value. And typically, gold does retain its value. It goes up a little, right? When people are worried about the world ending or the economy falling down, you'll see gold spike up. Maybe if there's high inflation, you'll see gold spike up. But if you look at, stock markets versus gold over the long term, it's not even close in terms of the stock market being a much better investment, because the inherent value of gold isn't much. You can see it, you can feel it, you can wear it on your fingers, but it doesn't produce cash flow. It doesn't produce profits like investing in a business. It's really seen more as a store of wealth, hoping that in the future people will value gold just like you do. Another thing we have, and this kind of comes because of the financial markets, is insurance. Now, not everyone may believe in insurance, but if you're driving a car, I think legally you have to have some insurance. But the thought process with insurance is that if everybody chips in a little, then we can all be covered for a big loss. So what we do is we give up a small loss in terms of the premiums we have to pay, but then we never have to worry about a really big loss in terms of like losing the car because it got totaled or the house catches on fire, which could, financially ruin you, right? With a little bit of insurance, and with insurance companies can then collect that from a lot of different people, and then they can raise capital and invest that money in the stock market so they have it available and ready in case something happens. So those insurance companies are a big part of the financial system. In fact, if you ever heard the name Warren Buffett, he's one of the most famous investors there is in the United States. He basically got to be who he is from insurance, because he bought insurance companies, and insurance companies he found were not doing a good job of investing their money. And so he did a better job of investing the money that the insurance companies have, and that really propelled his Berkshire Hathaway company. Liquidity. So liquidity is the ability to sell something quickly without having to drop the price, right? So if I have $10, I can sell $10 in cash easy, and someone will give me something for it, and that's pretty easy. If I have a money market securities, I can sell those quick and easy on the financial markets. But what if I have a house? What if I want to sell my house today? How much would I have to drop the price to be able to sell it today? I don't know, 5–10%. So something that is not very liquid is something like maybe a house, maybe a used car, depending on the car, right? If you want to sell the car yourself on some kind of Facebook marketplace, and you try to get the real value you think it's worth because you looked it up on Edmunds, maybe it's going to take a month to sell it. But maybe if you drop the price by 30%, then maybe you can sell it fairly quickly. So that's a measure of liquidity. How much do you have to drop the price to be able to sell something quickly? And when times are bad, investors gravitate toward things that are liquid, because they know that then they can change and modify their portfolio quickly. So that's where like bonds issued by governments are often the preferred place. And things that trade on financial exchanges are also more liquid, because we know we have all these buyers and sellers coming together. So that ability to buy and sell quickly without having to drop your price is a one benefit of financial markets. Another thing which we don't necessarily think about is they give us an idea of what competitive interest rates or actual trading prices or values are for things, right? Because once we have a market where lots of people are buying and selling, taking out loans, selling stocks, buying stocks, we can kind of see what everybody's paying. And that gives us an idea of what the market, the going rate is for a type of loan, for a certain type of bond interest rate, for the price of a stock. But if you're looking at a market and it's kind of closed and nobody's publishing their prices, you'll have a hard time determining how much you should ask for or how much you should get for your car, right? Because right now, if you want to sell a car, you'll probably go to a couple different websites and hopefully that information is accurate. But then you'll notice if you go to a car dealer, they'll say, oh, I don't listen to that price. You know, you have to go to Manheim Auto Auction pricing. And, oh, well, I can't sell that model anyway now. So they'll come up with, lots of reasons, and it becomes a negotiation versus taking a look at the real market prices. It's hard to get that information. So those are some of the benefits of financial markets. Cost of capital is basically the interest rate that you have to pay for money to get money for your business. So like, what's it cost you, your business, to take out a loan from a bank? You can think of that as your cost of capital. Capital is what you're borrowing money, and what's the cost of it? That cost is an interest rate, right? So what's the loan cost when your company wants to borrow money? If it's coming from a commercial bank like Fremont Bank, what's the interest rate? That's the cost to you. If you're borrowing money on a credit card, what's the interest rate on that credit card? That could be 23% or something. So that's the rate of return that capital is costing you. But another way to look at that is from not the company's point of view, but from the investors. And so let's say I have a certain amount of money I want to invest, and I see like 5 or 6 different loans that I could make. And one company is willing to give me 17% interest rate when I lend them money. Another one can only afford 12% interest rate. So I, as an investor, right, I look at all the different opportunities I have to lend out my money, and I'm going to go to the one with the highest potential return. And so that's my opportunity cost of capital. So from a standpoint of a company trying to raise money, they have to think about that when they go to ask for money, that investor is going to look at all the different options out there available in the financial markets. And if the company is asking for a really low interest rate, they're not going to get it. In fact, if that company is similar to another company over here that can afford a 15% interest rate, then the investor is going to say, hey, I'll give it to you, but you're going to have to pay me 15%, not 12%, because I can get 15% from this company over here, and they're the same type of business as you. So that's what we mean by opportunity cost of capital. It's what investors can get on other investments with similar risk when they look around the financial markets. So, it's good in a way, because now investors have choices of where they invest their money, and they'll go to where they have the best opportunity to make a return. And if you've got the same risk as another investment, you're probably going to have the same interest rate on your debt as the other investor. So that's what we mean by opportunity cost of capital. What other opportunities are there for investors? And that will determine the price that companies have to pay when they take out things like loans. And so that's why we say financial markets determine the firm's cost of capital, because investors can look at all the different opportunities in the financial markets and they're going to base that information when they look at a particular company and investing in that company. They're going to look at all the different opportunities that they have. Here's an example. Let's say your friend runs an IHOP restaurant and asks you to buy shares of stock. He says the stock will return 12% this year. Then you have another friend, and they're an analyst at Citibank, and they analyze restaurant stocks. And that analyst says, you know what? Similar companies will get you 15% return next year, right? So from your standpoint, would you rather have a 15% return or a 12% return? And this is from the investor's standpoint. And so obviously 15% is better. And so does IHOP look like a good deal? Probably not, right? So now you're going to go back to your friend and say, hey, you know what? I'd like to buy some of your stock, but I see other restaurants promising, or not promising, but expecting to deliver a 15% return. You need to do the same thing for me to buy your stock. And so that's what we mean by opportunity cost of capital. It's where these investors look at all the opportunities, and the baseline for a certain amount of risk is what determines that asking price, if you will, or that expected return. Because you're looking at all the different restaurants now, and you want the same return as you can get on other investments. You're not willing to give them a discount by investing their stock for only a 12% return. You want the 15% return that you can get in other places as well. That is chapter 2. Any questions on chapter 2? How does the company come up with the return percentage? So in this example right here, let me give you an example. The return on a stock comes from two places. It comes from the dividends, and it comes from the stock price going up. So in this example, let's say your friend thinks, you know, the dividend is going to be worth 5% of the stock price this year, and we think the stock price will go up 7%. That's a total of 12%. Whereas your friend at Citibank, you know, they looked at all the other companies and they said, you know what, those other companies also returning 7% this year on the stock price, but they're going to have dividends of like 8%. So that's an example of where it may come from.
I have a question.
Yeah.
So with COVID and stuff, when companies gave like their rate of return, like what happened this year when they realized, oh shoot, our revenues aren't really like as much as we were expecting to? Like, did they have to go in and like reevaluate and give out new rates of return?
Well, when I talk about rates of return here, I'm technically companies won't tell you how much their stock will return that year, because they could get in legal trouble for that. It's like making a promise. They will tell you what they expect the dividends to be, but typically they won't tell you what the return on the stock will be. They can have an idea, but they try not to make that public. And so that's kind of why I said a friend who runs it kind of told you this on the side.
Okay, that makes sense. Thank you.
Yeah, companies have to be very careful about making promises, because at least in this country, if they make a promise and it doesn't happen, they'll probably get sued.
Yeah, definitely.